welcome back to this final video of this 6 video series. And in this video we will be talking about the merchandising activities in accounting. So this presentation will explore the key aspects of the merchandising activities or in the realm of accounting, which in which we will talk about how merchandising activities do their particular accounting, what are their systems of recording inventory, and what methods of accounting they use in their proceedings. And without any further ado, let's get started. So let's move on to our next slide. It is about the introduction to merchandising companies. So let's begin by understanding what merchandising companies are and their role in the economy. So unlike the service companies which sell intangible services, merchandising companies focus on buying and selling physical goods. So these companies are critical in bringing the gap between manufacturers and consumers. So there are two main types of merchandising companies. First is the retailers and the other is wholesalers. So the retailers, these businesses sell goods directly to consumers. So their examples include superstores, clothing stores, and online platforms like Amazon. So their goal is to make the shopping experiences convenient and customer friendly. Next we have wholesalers. So these businesses buy goods in bulk from the manufacturers and sell them to retailers or their businesses to other businesses for the purpose of resale. So for example, a wholesaler might distribute large quantities of electronics to retail chains. What sets merchandising companies apart is their reliance on inventory. So inventory is the management of inventory is crucial for their operations. So as it directly affects their profitability. So the ability to stock the right products in the right quantities at the right time is essential for their success. Now let's move on to our next slide. It is about the operating cycle of a merchandising company. So the operating cycle of a merchandising company is the process that outlines how the businesses manage their inventory, sales, cash flow. This cycle consists of following three key steps. So first is purchasing inventory. So the cycle begins when the company buys inventory from the suppliers. This could involve negotiating purchasing prices, arranging shipping, and paying for goods. So the proper inventory purchasing is essential to avoid overstocking or understocking. So next step is the selling the products, which is the key and the most important part. So once the inventory is stocked, the company sells it to the customers either for cash or on credit. So the sales that generate the revenue, which is the lifeblood of this type of business and practically any type of business. So the merchandising companies must focus on the effective pricing strategies and customer satisfaction during these steps. So the next step is the collecting of cash. So finally, the company collects the cash payment or cash from the customers in cash transactions. This step happens instantly, but in credit sales it is a bit tricky. It involves managing accounts receivable and ensuring that they are paid on time. So let's move on to our next slide. It is about the income statement of merchandising companies. So now that we understand the operating cycle, let's look at how the merchandising companies report their financial performance through their income statements. So their income statement provides a clear picture of profitability by detailing revenues, expenses, and the cost of goods sold, COGS. So their key components are their sales revenue and their COGS, as we have discussed earlier in our analysis of income statement in previous videos. And I have also talked to you about other key components of the income statement in previous videos. So it is a bit similar to that. So what is the one thing new will be, what is the formula for cost of goods sold? So it will be the beginning inventory plus the purchases minus ending inventory. And then we move on to our next slide. So next slide is about the inventory system, perpetual versus periodic. So effective inventory management is essential for merchandising companies, and the method used to track the inventory directly impacts the financial accuracy. So the two primary systems are used, which are perpetual and periodic inventory systems. So the perpetual inventory system, in this system, inventory levels and the cost of goods sold are updated continuously in real time. Each purchase and sale is recorded immediately in the inventory system. And then there is the periodic inventory system, in which in periodic inventory system the inventory and cost of goods sold are updated only at the end of an accounting period after a physical inventory count is conducted. So in a perpetual inventory system, modern technologies like point of sale POS systems they automate the daily transactions, or they sometimes the companies also use manual tactics for it. Whereas the periodic in a periodic system, it is simpler and more cost effective than a perpetual inventory system, making it suitable for smaller businesses and which have limited resources. So let's move on to our next slide, which is about taking a physical inventory. So regardless of whether a company uses a perpetual or periodic inventory system, conducting physical inventory counts as essential for maintaining accuracy and accountability in these merchandising companies. So this process ensures that the recorded inventory levels match the actual stock on hand. Following here are some of the key steps in taking a physical inventory. So what are these steps? They are verification, then there is reconciliation, and then there is adjustments. So one important aspect of the physical inventory is that identifying shrinkage, which refers to the loss of inventory due to theft, fraud, or damage, or something like that. Let's move on to our next slide, which is about transactions related to purchases and sales. So merchandising companies regularly engage in purchasing and selling inventory, which is basically their business model, and accurately recording these transactions is crucial for financial reporting. So let's break these down into categories for purchase transactions and then sales transactions. So what are the purchase transactions? So first is inventory cost of inventory includes the purchase price, the freight in transportation, which means the transportation cost or any other expenses that are directly related to acquiring the goods. So the discounts, next purchasing transaction is the discounts. So suppliers often offer purchase discounts as the incentive for early payments. For example, a 2x10 net 30 discount means that buyer gets a 2% discount if payment is made within 10 days. So the next transactions are the sales transactions. The first transaction will be revenue recognition. So revenue is recorded as at the profit of at the point of the sale, either for cash or credit. For credit, sales accounts receivables are updated, and then there are the sale discounts. So these are offered to the customers to encourage early payments. So they reduce the total sales revenue. But they are actual sales. Then we move on to our next slide, which is about closing entries in inventory system. So the closing entries is an important or integral part of accounting process for merchandising companies as they prepare the accounts for the next accounting period. Let's examine how these entries work. So work in these inventory systems. So in the perpetual inventory system, inventory and cost of goods sold are updated continuously with each purchase and sale. At the end of the period, closing entries are made to transfer revenues and expenses to retained earnings account. And then adjustments are minimal since inventory levels are already accurate. Then there is periodic inventory system. In periodic inventory system, inventory and cost of goods sold are not updated in real time. At the end of the period, a physical inventory count determines the ending inventory of a business or ending inventory balance. So let's move on to our next slide, which is about financial analysis of merchandising companies. So financial analysis tools are essential for assessing the performance and efficiency of merchandising companies. So here are key metrics used. So first is gross profit margin, then there is sales per square foot and other financial ratios that measure this financial analysis. So gross profit margin we get this metric measures the profitability of a company's sales after the accounting for cost of goods sold. So then we move on to our final slide, in which we will provide our concluding insights. In conclusion, merchandising activities form the backbone of the retail and wholesale businesses, and their accounting requires a clear understanding of inventory management, of financial transactions and reporting. So we discussed the key components of this merchandising accounting in our today's session, and I hope it was helpful in understanding more about accounting and business aspects of things on your side. Hopefully I will further see you in many other videos about business and related activity.